Search.
А что? Хочешь пригласить меня на свидание?
Может быть. Парень. Ты не назвал?
Good evening, everyone. Hope you guys are doing good today. Welcome, even those of you who are new to the MMC footprint. So what we'll be dealing with here is a strategy called the MMC footprint, which is applicable on all the time frames, which is applicable on all the pairs. You can literally apply it on NASDAQ, volatility index, currencies, and in terms of time frames from 1 minute to one one month time frame. So what we normally focus on here is the pattern that formulates in the market on daily basis, and basically each and every second there is a footprint on any random pair because of the market moves in footprints. So there's always a footprint. If the market it is not in a footprint, you haven't checked correctly. You just have to know how to read the chart using this footprint thing moving forward. So normally what we look for in the market is a pattern like this. And that pattern, on top of that pattern, I'll be drawing lines, and those lines I'll be giving them names. Let me use a different color. That line, I'm calling it the footprint line. Second line I'm about to draw is called the first layer line. And from there, the first layer line, you guys must know that it is the most important line. Why is it important? Because it is the one that distinguishes whether we should continue looking at the direction we're looking, or we're expecting the market to turn into the opposite direction. And normally what we wait for is for the market to break the first layer line. So you just simply wait for the market to break the first layer line, and after that it has to make a retest. But the retest can be lower than that line. We don't want that. We want the same scenario here, but in a different direction. So here you'll be spotting what we call divergence, which is a technique that we use in order to make entries We use this technique for re-entries, and we use any form of entry. We use this technique. So what you can do from there is be able to implement it between those 2 points. And how exactly do you implement it? Normally on your MetaTrader 4, the settings are quite default. Né? So what you have to do, you just have to click on your stochastic. After you click on stochastic, you just accept everything. You don't change any settings from there. Now, when you don't change any settings, it will give you a chart, a stochastic chart that majority of people use. It will give you this the chart movement in the standard that everyone uses, that kind of a chart. Now, with that being said, when we know that, okay, majority of people are using this chart, and for a fact we know that a majority of people in Forex are losing money, that means whatever the stochastic is telling us, we must implement the opposite of what is actually happening. Now, when I mean the opposite is that in a normal way, a stochastic, the market normally moves like this. In a normal way, if this point is lower than that point, it must also be the same here. So you guys can see from here to there, from there to there, the market is ascending. So that's how everything should be. Now, once you start looking at this in the opposite direction, once you start implementing the opposite of what is actually happening, comparing 2 points, I can use this point, and I can use that point. I can use this point, and after that I will use that point. You'll be able to see that between those 2 points, you can see the total opposite of what is actually happening. And now that's what we're looking for. So immediately, when you guys see the stochastic, it ranges from 0 to 100, and from 0 to 20, it means that the market, it is oversold. It is when the market it is oversold. And from 80 to 100 is when the market is overbought. So we always look for divergences where the market give us a divergence touching the overbought or oversold. So we always want those kind of scenarios. An example, you can see here there was a divergence where the market, the stochastic, touched 20 line from there going down, which is where it touched the oversold. And for the buy, for the sell trade, let's make an example. All right, perfect. So for the sell trade, if you can compare 2 points, compare that. Okay, when the market was here, the stochastic was here. When the market was there, stochastic was there. And here's another scenario where both of these points, or both of the points on the stochastic is touched the overbought line. Now, as long as the second point is touched the overbought or oversold, we don't care really much about the first point. What we care about is the second point, touching the overbought or oversold. And after that, the final thing that you'll have to do to confirm whether you'll be buying or selling the trade is the crossing over between the two stochastic lines, and meaning when the other line came to cross the other line, that's when you start piling up your trades. That's when you start making entries from there. And let's go back to the whiteboard. So the same technique you applied between this point and that point. You're going to be entering a buy there. The market will go into your direction. As it continue to go into your direction, you add more re-entries. Okay, you add more re-entries using the same method. But now what you can do is that you can start implementing it on a smaller time frame. Why on a smaller time frame? Because of, let's say, for example, you are analyzing this on 1 hour. And as you're analyzing, draw your footprint and drawing your first layer on 1 hour, when you're going to make re-entries and you make it at around 15 minutes and 5 minutes, that way, meaning you'll be looking for divergences on 5 minutes and 15 minutes around them. First of all, each and every time frame have its own divergences, right? So any time frame you'll find divergences, but the lower time frame you go to, the more divergences that will form within a short space of time. So meaning it takes a small time frame to create a lot of divergence, because let's say, for example, in an hour, how many 1 minute candlesticks are in an hour? So far, how many divergences will you be able to see with those candlesticks? So it makes sense that way. It's just a thing of time flexibility, and also in terms of how you're going to be holding your trades, right? So as the market keeps on making retests, you spot more divergence and enter trades. It's the same thing as it continues to go. After that, you implement the same thing. As you implement the same thing, the same footprint, same first layer. Those of you who don't know what is happening here is that we take our profits when the market breaks the first layer. So why are we doing that? Is that it is very, most people in the, they have their own fixed amount of pips for all pairs and for all time frames. But what they don't consider is that the market is not, I mean, the market movement is not always the same every day. You can't guarantee that the market will react the same way as it did yesterday, in the same way, in the same momentum, that kind of a thing. So now, when we're able to track if the market is about to go into our opposite direction with the first layer, that's something that we can consider so that we can be able to know when we should actually pull out, because of we know when the market is about to go to start going into the opposite direction. So now we use the first layer. So you find that some of the trades, they're big, some of the trades are small, but it allows the strategy all in all, even though you can hit the market up and down, it allows you to have access to every little movement that is happening, regardless of the time frame and how big the structure is, because of you just simply observe with the footprint and check when the first, I mean, if the first leg is broken and you're on the trades. Imagine you're on a trade here, you implemented footprint perfectly, you entered buy here, you entered buy here, you entered buy here. The market keeps moving into profit. And when it comes back until this point, that's when you want to close the profit, because sometimes you can easily get wiped out. So in order to avoid situations like this, there are lines that we draw, which is like the first layer line, this one, which will be the one that will inform us when the market is going into the opposite direction. So showing that practically, let me do this. Mm, let's check out NASDAQ. So let's say you would have used this one as a footprint, and you would have used that one as a first layer. So if you would have used that point as a first layer, you would have gotten out immediate after the first leg gets broken, which you will be very safe, because of if you would have drew it like this, you're going to close here, and immediately after it closes, from there you're going to take the market into the opposite direction, And even though before that, you can see what happened from there. So there is always an answer when it comes to this. Strategy. You just have to be patient with looking, and of course practice more so that you can be able to spot opportunities on time. And from here, what I want us to do is take a look at the trade that we analyzed like on Friday. Yes, this. So those of you I was hosting a Zoom meeting. I think it was in the morning actually on Friday, and we saw this trade, and we've analyzed it, and what we were seeing here was very, very clear. I'm going to repeat on what we've seen at that particular time. So just a simple footprint, and after that, first layer. So I see that okay, the market was around here. No, it was around here. Then I was like, okay, it's in the same position as when you would have entered when the market broke there. So looking at time frames and being able to look at even 4 hour, we saw a very good divergence there. That can be able to give us that movement. So now since we've entered there, there's more opportunity to enter more. Why am I saying that? Because I'm looking at, you guys can see it, a clear divergence, and we're still on a buy. So when the market opens, we still expect this thing to go into more profit. As you guys can see, from this point to that point, from this point to that point, let me check 1 hour. It should be able to give us, yeah, it will only give us the crossover. So when the market opens, you will see a buy. This thing will continue giving us money with the buy. And yeah, I hope those of you who took it with me were able to benefit from this. And right now, I also want to look at another pair that we can be able to keep our eye on. And what I'm just going to do is that browse through each and every pair, looking for a potential trade that we can be able to jump on. This thing has left us, eh? Yes, yes. Okay. Excuse me, let me wait for it to load up. Okay, there we go. Yeah, and even this pair, it is going up. The reason why I'm saying that is because of just even the footprint. The market even broke the even footprint itself, and it's starting to create a divergence on 1 hour. Let me check if these lines are corresponding. Sorry. So I'll say they're much on the horizontal line, but 30 minutes should tell me something. Yes, of course. There's something very clear on this time frame, and the reason why we're also seeing buy on USD CAD is because of all the pairs that has USD on the left hand side. Your USD ZAR, USD CAD, USD JPY, every pair that has USD on the left hand side, it's on a buy. How do we know that? Is that we're able to comprehend the movement of few of the pairs, just like this. It doesn't make any sense for others to be on the opposite directions. So the reason to show what I'm talking about, you see this, I'm clicking on GBP USD. I should be able to expect a sell on GBP USD, which was very clear. Why? Because of simple thing that we call correlation. Oh yeah, this is, if I was to draw those as a footprint first layer, even though I haven't drawn them carefully, I mean, if the market that hasn't broken, you can still see divergence that was very much clear. The market started going down. So when you go to 1 hour, you should be able to see that the market, the stochastic is crossed to the downside from there. So what is going to happen is that if you have any questions, you guys will send a VN or questions in the group. I'll be able to reply to them there, because here I'm trying to be as productive as I can in terms of giving information that is relevant to you guys. So as you guys see, there was a crossing over to the downside as expected. So any other pair that is a USD on the right hand side, even this one, I know it's a sell for effect. It's a beautiful set. This one, when the market opens, immediately when it opens, if there's no jump, because sometimes the market can just jump, you simply take a sell like without hesitation. And I know for a fact that there's a footprint associated with this. There's no way there isn't. That's the footprint. Some can use this one as a first layer. Some can use that one as a first layer. Now you just put the divergence in order to keep taking this thing to the opposite direction. Now, as it continues going into the opposite direction, we're going to use this as a footprint. And after that, we're going to, after we enter sell here and the market goes down, like that, we're going to draw a first layer here. So that when the market decides to come and break there, we know that, okay, now it is about to start going into the opposite direction. So from there, we must definitely pull out of the trade. So the strategy is quite simple and straightforward, guys. Something that is working, you don't have to convince yourself that it is working. It will be self-explanatory. You don't do much. All you just do is simple thing. Implement draw your footprint. After draw your first layer. After that, look for the breakout of the first layer and spot your divergence and execute. Simple as that, nothing big. Okay. Don't complicate trading, because when you complicate trading, it will complicate your life because you'll be making things hard when they're already easy. So I'll also resend the steps in the group so that the new guys, or like what must happen is that those of you who have been here or who have been here for some time, please send the steps I normally send in the group so that some can be able to receive them. So that I don't have to rewrite them. And then when you have any question, what you will do is that you can send a VN on WhatsApp. After you send a VN on WhatsApp, just Destiny, thank you for the steps. Let me forward them to group 2. All right, yeah. So the steps are sent there. As you guys can see, if you can check the WhatsApp now, the steps are sent. So just a matter of what 2 points. Just a matter of getting into detail of how you must draw your footprint line. You spot 2 points where you'll be the first 2 points of the trend, where you'll be able to draw your footprint line. The second and the third point. The second point, you're gonna use the second point of the footprint line and connect it to a third point in order to draw a first layer line. Then from there, it's just a matter of waiting for the market to break the first layer line. After the market breaks the first layer line, you're gonna wait for it to retest. After it retests, that's when you're gonna start spotting your divergence now. Simply after you spot your divergence, you have to also look at the stochastic and know for a fact that there are divergences everywhere. Okay. Know that there are divergences on all the time frames. Each and every time frame has its own divergence. Now from there, what you must do is be able to choose a divergence. Don't like if you've analyzed on one now, don't go strictly to 1 minute, because 1 minute is quite a very, very small time frame, and there's just too much volume there, a lot, you see. So if you can go to 1 time frame below, or maximum of 2 time frames below the chart. If I'm analyzing, if I'm on 1 hour, I'm gonna go to 2 time frames below. So normally we don't have 45 minutes. I'm gonna go to 15 minutes in order to make a divergence. I mean, to spot a divergence, and you will get your answers. You will still get your answers. You will still get your answers from there also. And if you are analyzing on 4 hour, if you are able to skip 2 time frames from 4 hour, doesn't necessarily have to be, because like if you can just 4 hour, just keep 4, I mean, in your have 4 hour in your mind as 4 hour. And when you go 2 time frames below, meaning you're supposed to go into 2 hour time frame, and we don't have 2 hour time frame. So meaning what you just have to do is that you can just make a spot your trades on 1 hour. If you're analyzing on what? On 4 hour. Simple as that.